Hi, I'm Shae Russell from Fat Tail Media, and joining me today is Jordan Eliseo. Jordan is the Manager of Listed Products and Investment Research over at Australia's Perth Mint. Jordan, thank you for being here.
Pleasure, Shae. Thanks for having me on.
Now, thank you for joining us today. There's a crossover here of a few audiences. We've got the Sprott Renaissance Conference joining us, as well as obviously the people in Australia. Now, people in Australia are probably a little bit more familiar with your work, but for our Canadian and our US friends watching, could you please tell everybody what a Manager of Listed Products and Investment Research does?
Sure thing. Yeah. So I suppose there's two key parts to the role. So the investment research piece is probably easier to cover up front, which is essentially my key part of my job is to produce market commentary, looking at what's happening in precious metal markets, broader financial markets and the economy, and essentially the role that gold and silver, other precious metals as well, can play in investment portfolios. And that's obviously something I've done for many years and I'm very passionate about. And then the listed products part of the role is focusing predominantly on our ETF range. So here in Australia, we have an exchange traded product that was listed on the ASX back in 2003. The ticker code is PM Gold. And so I do a lot of, I suppose, business development work there, making investors aware of that product and how they can use it in their portfolios.
Now, gold's had a stellar run this year, and it cracked in US dollars, at least it cracked over 1900 last night. So has it gone too far, too fast? And has it gone too fast, too fast? Let's stick with that one first.
Yeah, look, I don't know that it's gone too far, as in, this is kind of the bull market top, but possibly it's gotten a little ahead of itself in the last few weeks. So if you look at where we are sort of year to date, the metal's up about 25% in US dollar terms, pretty similar number in Aussie dollar terms as well now. So that's if it was the 31st of December right now, you'd say, that's been an amazing year for gold. However, when you sort of kind of contextualize it in light of everything that's happened this year with COVID-19 and the volatility in equity markets, decline in real yields, it's no great surprise that gold has moved as much as it has. It wouldn't surprise me to see that the market take a little bit of a breather for now. I think if you look at most markets, not just gold, equities, other markets as well. None of them go up in a straight line. And this $1,900 level that we're at now is particularly important for gold because it was in nominal terms the all-time high that we saw back in 2011. It would be a bit of an anomaly if it just blew straight through that rather than possibly consolidate for a little bit of time. So I wouldn't be surprised to see the metal take a bit of a breather, probably be quite healthy for the market. But I think the direction of gold, I think prices are biased to the upside for some time to come.
Now, you recently discussed a Bloomberg article that, it relied on a couple of well-worn myths. One of those myths that's frustrating for us in the gold market is that gold only performs during inflation. But you have hard data to suggest otherwise. Can you expand on this?
Yeah, absolutely. So, look, I think it makes sense why the myth exists because, gold's, I suppose, greatest bull market run in anyone's lifetime that they can remember was, of course, during the 1970s. Price went from, $35 to over $800 an ounce at one point. And obviously that was a period of, stagflation, high inflation. So, that era is kind of almost, it's the impression that it's left in the market is very strong. So people say, well, yes, you should own gold if inflation's high. But if you actually take the last sort of 50 years worth of data since, gold was essentially, demonetized for want of a better term, you can see that the relationship is nowhere near that clear. So yes, during the 70s, we had quite high inflation and gold did very well. But if you look at the 80s and 90s, inflation was still relatively high, certainly compared to where it is today. Yet gold did very poorly. We're basically in a 20-year bear cycle, between 1980 and 2000. But then, of course, in the last 20 years, gold has outperformed everything. It's up, the better part of 500% in sort of US and Aussie dollar terms in the last 20 years. And that's despite the fact that we've had the lowest inflation on record. So, in the last 20 years, and I'm using US figures here, inflation has averaged barely 2% per annum. Yet gold has risen by around almost 10% per annum, and as I say, outperformed equities, outperformed everything else. So, if you genuinely believe that gold only did very well during high inflation environments, you'd really be scratching your head to go, well, how come it's had such a massive bull run in the last 20 years? And I think the only conclusion that a sensible investor can draw from that, or a sensible market analyst, is that high inflation is definitely a tailwind for gold, but it's not the only tailwind and it's not the only driver. So, if we have equity market volatility, if we have declining economic output, stresses in financial markets, credit spreads flaring up, you name it, then there's going to be solid demand for gold anyway. So I think the key takeaway for investors is, keep an eye on inflation, and if inflation picks up, that'll probably be good for gold, but there's no need to not be an investor for gold just because official CPI rates are quite low right now.
Now, from there, let's move forward to physical demand. How has physical demand for gold changed? I mean, are we seeing people queuing up out the doors of the Perth Mint? Are retail investors demanding more gold, or are we seeing more inflows into gold ETFs?
Yeah, so I think the real story of the year is the gold ETF story, and I'll talk about that in some detail. But just to give a little bit of flavour on I suppose minted product sales. That's physical bars and coins that are, as I say, made with a sort of minted finish, as it were. And if I look at sort of the Perth Mint sales there over the last 7 or 8 years, in an average month, the Mint would probably sell around 40,000 ounces of gold, just over that, just slightly higher. In sort of March this year and April, we did 90,000 and then 120,000 ounces. So we're talking somewhere between 2.5 to 3 times the sort of regular figures. And those numbers are kind of back to levels we saw when the GFC hit. So the demand for, let's call it physical bars and coins by retail investors is very significant right now. And I think, we're not the only manufacturer or fabricator of metal and minter of metal that's seeing that. But unquestionably, the real story has been the gold ETF space. So if you look at what's happened there, and I'm only talking about data to June, we've seen even more inflows in July. In the first 6 months of this year, we had over 700 tons worth of gold get purchased through exchange traded products all around the world. Now, that's more than the total amount seen in any calendar year leading into 2020. So even though we're only halfway through the year, we've already seen a record high. So more than what we saw during the GFC, more than what we saw during 2016 when Brexit occurred and when Trump won. And what's also interesting is if you actually then look at these numbers in terms of dollar value, it's even more extraordinary, because obviously the gold price now, the average gold price today or in 2020, much higher than what it was back in 2009 and even in 2016. So the scale of ETF demand is absolutely unprecedented right now. It's predominantly happening in North America and in Europe, but it's also happening here in Australia. And again, to provide some color on that, or a statistic that might be interesting. So Perth Mint Gold, PM Gold, our own listed products, its holdings have grown by over 50% in the first 6 months of this year.
Oh, wow.
So, if you think that the product has been listed for 16 years and over 50% of the inflows have occurred in the last 6 months. So that's very significant. And then to even further contextualize that, if you were to look at that product relative to the entire ETF universe in Australia, and there's about 200 ETFs here in Oz, and you were to sort of say, okay, well, look, let's strip out all the little ones, because there are some that are absolutely tiny with only a few $million in them.
Yep.
The Perth Mint ETF is the second fastest growing of all ETFs on the Australian stock market.
Oh, wow.
Yeah. So like PM Gold has been absolutely flying, and look, it makes sense. SMSF trustees, financial advisors, direct investors, you name it. The appetite for gold is very significant.
I'm glad you mentioned the GFC in your answer back then, because maybe it's because it's the market crash that's, of most recent memory. But a lot of people are comparing how this market tanked in March versus what we saw happened in the GFC. Now, you have noted before that there are some similarities and some differences as well. So could you please explain to everybody what you mean by that?
Yeah, sure. So I think that it's worth looking at both the similarities and differences, not just with gold, but sort of financial markets, broader macro as well. So I think the first thing is that gold performance was actually, or in both cases, has been quite strong leading into the crises. So if you look back to the GFC, gold was, it was in a bull market from sort of 2001 through to 2007, almost uninterrupted. Had a little bit of a sell-off during the worst of the GFC because it's, people needed to sell it for liquidity. And then obviously it's bounced back higher as fiscal and monetary policy has sort of come to the fore. So that sort of the dynamic in the gold market specifically was quite similar. We also saw relatively similar, I suppose, environment for equities as well. So equities were strong leading into the GFC. Equities had an amazing run in 2019 as well. So, in Australia here, the ASX was above 7,000 points earlier this year. S&P was flying earlier this year, back at all-time highs. We've then seen the correction. Where it gets interesting, though, now is that, obviously we've had a very big bounce back in equities in the last 3 to 4 months. And sort of if you look at valuations, they're now today at the same level they were before the market crashed when the GFC hit. So that's kind of that to me is interesting, but I think the key differences are sort of more worth sort of paying more attention to, and in my view anyway, they're more supportive of the gold demand story going forward. So there's 4 or 5 key differences that I can think of, and the first one is that very obviously there's a public health threat now that makes the economic recovery substantially more difficult than what we saw during the GFC. So, when the GFC hit, we had obviously significant capital misallocation in the economy and significant, I suppose, imbalances built up in the financial system. You'd argue we had both of those things this time around as well. Plus, we've got the threat of COVID-19. We're having to kind of, or some people would say we're not having to, but either way, we've chosen to essentially shut down the economies to try and control the spread of the virus. So that drastically complicates the sort of the way out, as it were. The other difference as well, or another difference worth talking about is, debt levels are much higher now. So despite all the talk of sort of austerity post GFC, the reality is that most developed market sovereigns have been running perpetual budget deficits for the last 10 years or 10, 12 years. And so debt to GDP ratios for, across sort of developed world are around 40% higher than they were 10 years ago. So, in as much as it makes sense that governments would want to deploy stimulus into the economy to cushion any fallout, like that's a perfectly logical argument, but the reality is we're just further in debt now this time around than what we were then. And some people would say this is a good thing. Other people would say it's a bad thing. The reality is that borrowing costs and yields are way lower now as well. So if you go back to the GFC, and I sort of find this pretty staggering, but in 2007 and 2008, if you were to sort of take that entire period as a whole, the US 10-year Treasury, the average yield on the Treasury was just over 4%. Today, it's barely 50 basis points.
Yes.
So if you sort of think about that, you sort of start to go, well, yields have dropped by 80+% over that time period. So there's 2 elements of this that are good for gold. One, from a sort of budget deficit perspective, governments have already benefited from this drastic reduction in borrowing costs. So it makes it easier to borrow now, but it suggests there's more sensitivity to rates rising in the future, which can complicate things. And secondly, from an investor's perspective, back in 2007, 2008, and I even remember this personally because we had some, with sort of family investments. If you wanted a safe haven because equities were crashing, you could just park your money in the bank or park your money in a government bond. Whereas now, as I say, that yield on the US 10-year is only 50, 60 basis points. The real yield is almost nearly minus 1%.
Yep.
So from an opportunity cost perspective, it's actually much better for gold now than what it was. And then the other part of this, which I think is interesting, is that whilst inflation rates officially are quite low, I think the risk to inflation is higher this time. And there's two reasons for that. And look, there's probably a lot of people that in the gold world that's almost going to sound like a bit of you're sort of just, hitting a broken record, because people have been talking about inflation for a long time now. But two elements here. One, the supply chain disruption because of COVID is far more significant this time than what it was when the GFC hit. So you can see the potential for input costs to rise. And the second point is that both fiscal and monetary policy are much more expansive this time around than what they were when the GFC hit. So again, the Fed is a great example here. The Fed took 6 years to increase its balance sheet by $3 trillion in the aftermath of the GFC. It did that in barely 3 months this time around. So the largesse being deployed is on a whole nother level. And also as well, I think that the actual, and I'm going to get, I might get teased for using this word, but the zeitgeist around monetary policy is totally different now. So when central banks started using QE and ZIRP and NIRP when the GFC hit, everyone was really nervous about it. And the whole idea was, we'll use this as temporary policy, but we better walk away from it because there are clearly risks to it. This time around, not only are we doing more in terms of the scale of QE, but instead of saying, we better not do this for too long, the sort of policy discussion seems to be more around, well, what else can we do? Should we implement MMT? Should we drastically bring rates down to below zero? So I think that the sort of policy environment that we're in now is far more supportive of what some people would call financial repression for remaining in place for years to come, and all of those things to me on balance are supportive for gold demand.
Speaking of gold demand, perfect lead into where I was going next. We have seen enormous inflows of gold into New York and London this time around. Now, what is driving that? What is driving this move, New York to accumulate massive amounts of metals, but also too, what's the impact for investors?
Yeah, look, I think so what's driving it first, if you look at London, it's I suppose a relatively simple story. There's, as I said before, there's huge demand for ETFs right now. A lot of those ETFs custody their metal in London. I suppose that's part of the story there. If you look at what's happening in New York, obviously this year we've seen this, very strange development, and a lot of it is linked to COVID, where there's been this quite significant gap between the price of spot gold and the price of the futures contract trading on COMEX build up. Normally, the gap between the sort of near dated futures contract and spot gold might only be a couple of dollars. I think at one point in March, it almost hit $100 on intraday. And so, what you're seeing is a lot of people are willing to sort of go, maybe they're going long spot gold, shorter gold futures contracts. And we're seeing a lot of gold move into the COMEX warehouses to make sure there's gold available there for delivery. I'm not quite sure how long that's going to last for, whether that's a sort of permanent feature. I wouldn't necessarily expect it to be. In terms of the impact for investors, it's an interesting one, because in some way, since COVID happened, there's been, depending which part of the futures market you look at, there's almost been less activity in the futures market, and that's because banks have been dialing back their risk. Investors have been a little bit nervous about sort of putting more capital to work there. So, I'm of the view that the futures market's good for the gold market. I know not everyone agrees with that, but it adds liquidity. It adds a source of buying as well. I'm not sure there's a huge lesson in it for investors right now. I think the broader medium to long-term picture for gold is positive for all the reasons I've discussed before. But as I said, when you look at where the market is now, we're at $1,900 overnight. It's Saturday morning on the 23rd or 25th of July that we're recording this. I think people, I think that we could see a little bit of consolidation from here, Shae. I wouldn't be. That would actually probably be quite a healthy thing for the gold market.
Look, Jordan, that's unfortunately all we've got time for today. As usual, I love talking to you about the gold market. You've got a great insight, not just to the Australian gold market, but also to international movements around the world. Thank you very much for giving me your Saturday morning so we could get this out to everybody at Sprott. I appreciate your time, and I'm sure the Australian audience will appreciate it as well.
My pleasure, Shae. Anytime.
Thanks a lot.